They want you to watch the dip and sell the future. Because while you're staring at a red candle and thinking, maybe I should get out, one of the biggest institutions on earth is out here putting a number on the table that changes the entire frame. $5,055 gold. Not someday. Not in a fantasy. By late 2026. And if you think that's just a spicy headline, wait, because the same report points to something even louder. JP Morgan still sees $6,000 gold by 2028. So today we're not doing the weak take. We're doing the war room take. Why can gold pull back while the real target quietly rises? Why do you keep getting emotionally pressured into selling during dips? And why does it always feel like the public is being coached to do the wrong thing at the right time? The receipts. What JP Morgan actually said. Let's kill the word leaked before someone starts yelling. This wasn't a hack. It was a published forecast that got reported. Reuters reported JP Morgan analysts projected gold would average $5,055 OZ by Q4 2026, built on strong investor and central bank demand. They even quantified a core assumption. Investor demand plus central bank buying averaging about 566 tons per quarter in 2026. And then the kicker, the part that turns a forecast into a psychological weapon. JP Morgan's commodities strategy head called gold their highest conviction long and tied it to the coming Fed cutting cycle plus stagflation concerns, Fed independence fears, and hedging against currency debasement. That's not gold might be okay. That's a bank basically saying, this trade isn't done. It's evolving into a new regime. Now, if you want an even cleaner version from JP Morgan's own research materials. Their market outlook page also discusses gold soaring to $5,000 by Q4 2026 with a 2026 average around $4,753. So the $5K idea isn't a random internet myth. It's a real institutional narrative. So why does price drop when the forecasts go up? Because markets aren't truth machines. Markets are liquidity machines. And when an asset starts entering everyone's watching territory, the market begins to do something brutal. It tests the weakest hands first. Think of it like this. A bull market doesn't go straight up. A bull market climbs, then turns around and tries to throw you off the mountain. Not because the mountain is fake, because the mountain is real. And the only way to keep climbing is to remove the people who can't handle oxygen loss. So the dip is not always the thesis breaking. Sometimes the dip is the market asking you, do you actually own this? Or are you renting it for excitement? That's why you can have a week where the screen is red and a report where the target is $5,055. Different time horizon, different game, why they want you to sell without cartoon villains. Now let's talk about that phrase, they want you to sell. I'm not claiming illegal collusion. I'm not claiming a secret meeting in a dark room. I'm explaining something more boring, more real, and more dangerous. Incentives. Here's the simplest explanation. Big money can't buy size unless someone is selling. And the easiest way to create selling is fear. Not always malicious fear, sometimes just structural fear. A sharp pullback, a scary headline, profit-taking commentary. The rally is over vibes. And 1,000 retail stop losses sitting at obvious levels. So they want you to sell doesn't have to mean they're lying. It can simply mean your fear is their liquidity. When you panic, you provide inventory. When you provide inventory, they can accumulate without chasing price. And that's why the loudest be careful messages always peak at the exact moment you're most emotional. The two voices, what they publish versus what they position. Here's something nobody tells retail. Institutions can be bullish and cautious at the same time. They can publish. Expect volatility. Pullbacks happen. While positioning for. This is the direction over 12-24 months. Because their goal is not to be your therapist. Their goal is to manage risk while accumulating a strategic position. And Reuters' report about JP Morgan's gold view makes it clear they're thinking strategically. It frames the move as driven by diversification and multi-year hedging flows, not just a one-week dollar move. That's a completely different mind state than retail's. Should I sell because we had 2 red days? So when gold dips and you feel the pressure to sell, understand you're experiencing the friction between short-term volatility, long-term accumulation, The market is designed to make those two feel incompatible. They're not. Why $5,000 gold is even on the table? Let's make this number feel real, not mystical. A $5,000 gold forecast doesn't come from vibes. It comes from a few giant forces that institutions are tracking. Force 1, central bank demand. This is the big one. J.P. Morgan's forecast explicitly leaned on strong central bank and investor demand, with that 2026 assumption around 566 tons per quarter. And when Bloomberg says J.P. Morgan Private Bank sees gold topping $5,000 in 2026, it highlights central bank buying, especially in emerging markets, as the engine. Central banks don't buy because of YouTube thumbnails. They buy because reserves are strategy. They're positioning for a world where sanctions exist, trade blocks harden, currency trust becomes political, gold becomes the neutral asset. Force 2, Fed cutting cycle. JP Morgan explicitly tied its bullishness to the Fed moving into a cutting cycle. When rates fall, the opportunity cost of holding gold changes. Not instantly, not magically, but structurally. Force 3, fear of currency debasement. J.P. Morgan's analysts cited hedging against currency debasement as part of the demand story. That's the part most people underestimate. Gold isn't just an inflation trade. It's a trust trade. When trust in the unit weakens, gold gets repriced. Force 4. This isn't one bank. If you think this is just J.P. Morgan, here's the broader context. Reuters reported Goldman Sachs raised its December 2026 gold forecast to $4,900 OZ, driven by strong ETF inflows and continued central bank buying. So you have multiple major institutions circling the same zone, not because they're coordinating, because they're reading the same world. The dip is the advertisement. Now we enter the psychological zone. A pullback does something powerful. It creates a reasonable story for selling. Selling becomes socially acceptable. Your brain says, I'm being responsible. I'm protecting gains. I'll buy back later. And this is where the market eats people alive, because later rarely comes with comfort. Usually, the market does this. It drops and scares you out. It stabilizes while you wait for confirmation. It grinds up slowly so you don't trust it. It breaks to new highs without you. It only becomes safe again once it's too expensive. That's how bull markets transfer wealth. Not by hiding information, by exploiting how humans respond to volatility. So when the price drops and the forecast stays bullish, that tension is the whole story. The banks buy while telling you to sell frame. Let's frame this carefully. Banks don't need to tell you directly. The ecosystem does it for them. Financial media highlights fear. Influencers swing sentiment. Headlines emphasize dips. Risk narratives dominate. And the public gets trained to sell weakness. Meanwhile, the slow money, the strategic money, the reserve money, continues doing what it does. Accumulate quietly. That's why this feels like a conspiracy, even when it's just incentives. The system naturally produces fear-based selling, exactly when long horizon buyers need sellers. And the $5,055 forecast adds fuel to that perception, because it shows the long horizon view is still bullish. War room break, the conviction transfer model. I want you to picture a control room, not a secret one, just the real one. Liquidity and positioning. On one screen, price. On the second screen, positioning, leverage. On the third screen, narrative. On the fourth screen, flow. A dip is not just price moving. A dip is the system asking, whose conviction can we buy cheaply? Because conviction is what makes you hold through volatility. And volatility is what shakes conviction loose. So the dip becomes a harvesting tool, not always intentional, but always functional. Why this cycle is different and why institutions are getting bolder. Here's why you're seeing these aggressive targets now. The world is changing in ways that push institutions toward non-optional hedges. Persistent geopolitical fracture, reserve diversification, fear of policy instability, concerns about central bank independence, yes, that's explicitly referenced in the JP Morgan report, stagflation type worries. When those become credible risks, gold stops being a nice to have and becomes a strategic allocation. That's why JP Morgan's analysts framed gold's rally as diversification driven rather than just dollar weakness. That matters because diversification demand is sticky. It doesn't flip in a week. The 5 phases of a gold repricing. Here's a framework you can use to understand why you keep getting shaken out. Phase 1, the quiet bit. Gold rises slowly, most people ignore it. Phase 2, the institutional thesis. Research notes start coming out, forecasts rise, people shrug. Phase 3, the public wakes up. Mainstream coverage increases, new money arrives, volatility rises. Phase 4, the shakeouts. This is where we are in many assets when they get attention. Violent dips, fake breakdowns. Top is in narratives. Retail gets ejected. Phase 5, the repricing. Once the weak hands are gone, price moves faster. The shakeouts are not a bug, they're the mechanism. And big targets like $5,055 are basically institutions saying they believe the repricing phase is ahead. The sell signal trap. Let's talk about the most common retail mistake. When price dips, retail looks for someone to tell them what to do. So they go hunting for a sell signal, and they find it. They always find it. Because the internet will provide a bearish narrative on demand. But here's what institutions do. They don't ask, is the internet bearish today? They ask, is the macro driver intact? Is the demand driver intact? Is the policy regime moving my way? Is central bank demand persistent? Are forecasts being raised by major houses? That's a different game. Retail plays the mood game. Institutions play the regime game. Why the number is average. And that matters. You need to understand something about how professionals speak. J.P. Morgan said average $5,055 by Q4 2026, not one spike to $5,055. That implies they're modeling a higher sustained range, not a one-day headline. And when they talk about $6,000 by 2028, that's not a one-week trade. That's a multi-year thesis. So when you see a dip today and think the move is over, compare your horizon to theirs. Your horizon is often emotional, weekly, reactive. Theirs is structural, quarterly, strategic. That's why they survive dips and most people don't. The why they want you to sell list. Let me give you the clean list of why dips are so useful to big players. Dips create supply creep. People sell in fear. Dips reset leverage 1. Leverage gets washed out. The market becomes healthier. Dips reset options. The options board can become dangerously one-sided in a runaway rally. Dips restore narrative control. A rally makes bulls loud. A dip makes bears loud. Noise returns. Confusion returns. Dips test conviction. The market discovers who is holding based on thesis and who is holding based on dopamine. Every dip is a sorting machine. So if you feel like you're being pushed to sell, it's because you are. Not by a person, by a system that rewards emotional exits. The big picture. This is a reserve asset regime shift. If central bank demand remains persistent, if policy cycles ease, and if geopolitical fracture continues, gold has a reason to be repriced. That's why these large institutions are comfortable publishing big numbers. $5,055 average by Q4 2026, $6,000 by 2028, $4,900 and 2026 JP. Morgan's own outlook materials, $5,000 by Q4 2026. JPM Private Bank View reported by Bloomberg, topping $5,000 in 2026. This isn't a single bank fever dream. This is the institutional world quietly adjusting to a new set of risks. How you get trapped. The sell low, buy back high loop. Let's narrate the trap. Gold dips hard. You feel smart selling until it settles. Then it stabilizes and you feel unsure. Then it rises and you feel annoyed. Then it breaks higher and you feel FOMO. Then you buy back at a worse price than you sold. And now your emotions are compromised. That loop is the entire reason shakeouts exist. They aren't there to punish you personally. They're there to transfer assets from weak conviction to strong conviction. What to watch next? The SMART checklist. Not financial advice, just a war room checklist. If you want to know whether the $5,055 narrative is strengthening, watch. Central bank purchasing trends, ongoing demand is a core assumption. Fed cutting cycle expectations, J.P. Morgan explicitly ties gold strength to that. ETF flow regime, Goldman cited ETF inflows as a major driver of their raised target. Narrative pressure during dips, this tells you where the weak hands are. Volatility behavior shakeouts often precede continuation. So here's the truth in one sentence. They don't need to lie to get your gold. They just need you to panic during normal volatility. And if you don't believe that, then explain why the loudest fear always arrives during dips. While the most powerful targets get published in plain sight, $5,055 by Q4 2026, $6,000 by 2028. That's not a whisper. That's a signal. The only question is, will you treat dips like truth or like the admission price of a regime change